What are tail risk hedging best practices? If you have ever worried about sudden market drops and how they could impact your investments, you are not alone. Tail risk hedging is a strategy that can help protect your portfolio from those unexpected downturns. So, what are the best practices for tail risk hedging? Let's break it down. First, it is essential to understand what tail risk is. Tail risk refers to those rare but severe market events that can lead to significant losses. These events are often called left tail events or black swan events. They happen more frequently than traditional models suggest and can lead to sharp declines in the market. Recognizing that markets have fat tails is vital for effective hedging. Next, using options strategically is a key practice. Long put options are particularly useful for tail risk hedging. A long put option gives you the right to sell an asset at a predetermined price. As the market falls, the value of these options increases, providing direct protection against losses. You can also consider other strategies like put spreads or options linked to market volatility. Diversifying your hedging instruments is another important step. Relying on just one type of option can limit your protection. By incorporating a mix of equity index options, volatility derivatives, and fixed income instruments like treasury bonds, you can improve the effectiveness of your hedge while also managing costs. For instance, some tail risk funds allocate a significant portion to intermediate-term United States Treasuries alongside put options. Adjusting the size of your hedge based on market conditions is also a best practice. Tail risk hedging can be costly, as option premiums tend to rise when volatility spikes. It is wise to buy more protection when markets are calm and scale back when volatility is high. This approach helps optimize your costs. Accepting the costs of hedging is part of the process. Tail risk hedging may lead to negative returns during stable markets since the protection is not needed. Think of these costs as insurance premiums that pay off during severe downturns. Active management and risk controls are essential for effective tail risk hedging. Ongoing monitoring allows you to respond to changing market conditions. Setting risk budgets and limits on your exposure helps maintain discipline and prevents excessive costs. Consider geographic and asset class-specific risks as well. Tail risks can vary by region or sector. Your hedging strategies should reflect the specific risks in your portfolio. For example, strategies focused on United States equity indices may not address risks from other regions. Lastly, if managing complex options strategies feels overwhelming, you might look into tail risk funds or exchange-traded funds that specialize in tail risk protection. These funds typically combine options and fixed income holdings to provide downside protection, although they may have negative returns in rising markets. By following these best practices for tail risk hedging, you can better protect your portfolio from rare but impactful market events while managing ongoing costs effectively.